Thanks everyone for tuning in this afternoon. Got a lot of good stuff to talk about as it relates to day trading the E-mini futures markets. And I say the E-mini futures markets, but there's going to be a lot of stuff that you can apply to other markets, other time frames, all aspects of your trading. What I want to kind of cover in today's presentation, I'm going to start with talking a little bit about kind of the general market structure and market retracements. We'll talk a little bit about ways to identify the trend and why that's important so we can find good trading opportunities. We'll take a look at high probability setups that you can use for day trading the E-minis, various futures markets, commodities. We'll also look at how to set profit targets. Basically, I'm going to run you through my whole strategy as well as the most important part, kind of exiting the trade and how you can use multiple profit targets and trail stops to be able to scale out of your positions and stay in those winners longer. We'll touch a little bit on some of the psychology behind trading and specifically, kind of how you can make that shift from, amateur to more of a veteran trader. And we'll talk about trail stops. And then we'll also talk about, I want to give you kind of 10 things that are really important and have been pretty pivotal in my own trading. So I'll kind of lay out those 10 things for you at the end. I recognize quite a few folks here in the room, but for those that are new, my name is Tim Racette. I have a blog over at eminimind.com. That's where I share my trading thoughts and my approach. I've been trading since about 2006. I'm from the Chicagoland area. I've been a full-time trader since 2009. I got my start actually swing trading stocks, and then I moved over to day trading futures. I incorporated both now into my trading, and it makes for a really nice pairing. I know a lot of people come to futures first, or sometimes they come Forex and then futures. And a lot of times the reason for that is just the ease of entry, because you can start with a very small amount of capital and get quite a bit of leverage. But there's actually a lot to be gleaned from, taking a longer time frame approach. And so I'm, really thankful that I got started with swing trading. I also had the opportunity to, being in Chicago area, I was down at the Board of Trade. I got connected with some really great day traders who'd been trading on the screen since the late 80s, basically since the start of computerized trading. And all the guys in the trading pits kind of discouraged us from being down there on the floor and encouraged us to, work our way to the trading screen. And that's kind of where the future of trading was headed. So I had some really good mentors growing up and kind of going through the process in mid 2000s when I was kind of getting into it. I've had the pleasure to speak at a number of traders expos and CME group, things like that. It's always fun to meet folks at in person. And then outside of trading, I like to do a lot outside. I currently live out in Arizona and really take advantage of winter here in Scottsdale. So I'm a mountain biker. I like to explore the outdoors. I like to pretty much get outside whenever I can. Former Arizona ASU Sun Devil graduate. And so it's really nice to be out and enjoy Arizona when things are pretty chilly back home. You can find myself, YouTube videos is a great spot to go. Just search for eMiniMind, also on Facebook and Twitter. So we got a lot of good stuff to talk about. So I want to kind of run through everything here, and I'll keep my eye as best I can. The chat window will be recording the presentation as well. So feel free to take notes, but if you miss something, you can come back to it afterwards. So my kind of general trading style. I'm a technical trader when I'm day trading, very short term. We're talking 5-minute trades to, if I'm hanging on to a trade, maybe an hour, maybe a couple of hours. But I'm really focusing in the morning, those first 2 hours of the day. And that's really important because when I first started, I was trading the basically all day in the NYSE session, and then I was even waking up for the European Open, and it just got to be too much, and I was really being, you end up losing focus when you're stretched so thin and that wide across basically 12, 14 hours of trading. So I narrow my focus, and now I'm really concentrated on that first 2 hours of the day. And when you think about it, that's where most of the volume and activity is occurring. And so that's where I want to be active. Like I said, I continue. I also swing trade as well. And the key with day trading is, rather than trying to set profit targets each day and trying to hit $200 a day or $1,000 a day, what I'll do is I'll continue trading when things are going my way and I'm having winning trades and I'm in a groove, and then I'll stop trading on days when, like the last couple of days have been. Today, for instance, was kind of a strange start to the day, and so I didn't have a lot of opportunities early on, and so it's okay to stop trading when things aren't setting up, rather than try and force yourself to hit that daily goal. When it's a bad day, you're forcing bad trades. When it's a good day, you're stopping short, and so you end up doing the opposite of what you really want to do. And then I think it's super important to just kind of balance trading with life, with your larger plans and bigger picture. For me, that's swing trading stocks, obviously long-term investments, and then getting outside, getting away from the trading screen is super important to be able to internalize a lot of the things that we're focusing on intraday. And then just remember that trading is really a means to an end. If you're young and you're working towards retirement, trading is a vehicle to generate cash flow to get to retirement or to get to a dollar amount where you're financially free. If you're in retirement, maybe trading is a hobby that you enjoy. That is, the goal is to then generate some extra money on the side. So kind of finding where trading fits in your life, whether you have a current 9-to-5 job or you're looking to transition out. Figure out that long-term plan, and that's going to really help you get through some of the various dips in kind of the ups and downs that you'll go through. So let's get to kind of some of the technical sides of trading, starting with identifying the trend. And it's important to be able to identify the trend, not just so we can trade with the trend, but so we can identify where the market might be changing. And so we're talking about everything from pattern recognition to identifying the very specific, opportunities for placing trades. And we're looking at, we can get as basic as, uptrend, higher highs and higher lows, downtrend, lower highs and lower lows, but also where is the trend changing from downtrend to uptrend, from a range-bound market to a trending market. Because when we go through those transition points, regardless of what strategy you're trading or even what market you're trading, being able to identify those changes in trend, that's where the opportunities are going to present themselves. So a really good exercise, and you've probably heard me say this before if you're familiar with myself, I like to print out just a 5-minute chart of whatever market you're trading and go through, mark it up, mark the highs, mark all the lows, and kind of just mark the trend, mark where the current highs relate to the previous highs. So is it a higher high? Is it a lower high? And then we can start to really familiarize ourselves with, okay, this is what a trend day looks like. And when you can go through and find a lot of good setups on a nice day, you take a snapshot of that, and then you take a snapshot of the next time it happens, and you get 10 really good trading days, and you compare them all side by side, and you can kind of pick out the characteristics that make them similar. Then you take a day that was, you had a hard time trading, you got chopped up, you really couldn't find many setups, and you take a snapshot of that and you compare that with 10 other days that were, really tough to trade. Maybe the market just was all over the place, and you compare that to similar days. And then you begin to build this arsenal of, sort of observations that you can then pull out. Almost, you end up doing it subconsciously. And when you're looking through charts or looking through various stocks, you something kind of goes off in your mind that says, ooh, this looks like a good setup. Ooh, I want to stay away from that chart. And then you start to formulate this intuition, that the trader intuition that you hear about. That's kind of how it can start. So when we look at, where does the trend actually begin? Well, it begins when the trend can change from one direction to another. So, for example, if we're moving downward, we might have a series of lower lows and lower highs. And then at some point, we're moving lower low, lower high, lower low, lower high, kind of same thing over and over again. And then all of a sudden, pop, we get a break of a prior high. And now all of a sudden, we pull back and we put in a higher low. So this is the point, if I could just kind of highlight that change from lower highs and lower lows, where we start breaking swing highs and moving to higher highs and higher lows. And it may not be a downtrend. It could just be more like a rectangle where we're just moving sideways. And then all of a sudden we start breaking a swing high. It's that point that's the very highly opportunistic time to be jumping on board. So when I'm looking at like this lower low, all I'm doing is looking, where is this low in relation to the prior one? So you could say, well, this might be the first lower low, and then this is the second lower low, this is the third lower low. But to simplify things, it's just a matter of, where is this low in relation to the prior? Where is this high in relation to the prior high? And you can use a highlighter and kind of mark the trend on the day. And a 5-minute chart's nice because it gives you enough movement to go through and mark things, but not so much movement where it's just a whole bunch of noise. So when it comes to a specific setup that you can use to kind of capitalize on that trend change specifically, it starts with identifying that larger trend. And then I'm looking to enter when that new trend is either starting or has developed on a pullback, just like that prior screenshot was showing. So we've got the market moving in one direction, and then when the market pulls back, we have prior support if it's an uptrend. We have just a market that might need a little bit of a breather, and that's why it might pull back. We have a market that, typically the market doesn't go straight up and straight down. We sort of undulate or stair step our way up. So a lot of different reasons why the market could pull back. And so just like when I'm swing trading stocks, I'm looking for strong stocks, and I'm looking to buy strong stocks on pullbacks. And I'm looking to sell weak stocks on bounces. The same concept. I just took that from a daily perspective and drilled down to an intraday perspective, and started with identifying the trend, noticing, okay, we've got some higher highs, higher lows, and as the market is continuing, either starting that new trend or continuing in that trend, rather than trying to chase the market at highs or seeing a move start to form and then jump in, as we're making a new high. I'd rather let the market pull back, and maybe when not so many folks are looking in that direction, I can kind of jump on board, just like with a strong stock. When that stock pulls back for a couple of days, maybe it's not so much in the news media. People are kind of turning their heads the other way. I've already identified that it's a strong uptrend, and so I can get in with an opportunity when not as many other folks are. So just by simply, you can use any kind of Fibonacci tool, or just a way to, determine sort of that halfway mark for the market to pull back, and then I'm basically putting my order just a tick or two in front of the that 50% retracement, and then jumping in to the trade. When it comes to the next phase, we talk about entering trades, identifying the trend, and then entering trades, and then managing the trade as step 3. Trying to take advantage of, somewhere in the 2 to 3 to 1 reward to risk ratio is a really good place to begin, because it's very difficult to be scalping and competing with the computerized trading firms out there, and taking a couple ticks here and a couple ticks there. But when we look at, okay, if I could be right 50% of the time, but I could capitalize by having my winners be 2 or 3 times my losers, maybe catch a few big winners in there, and do things to limit the size of my losers. Now we're starting to develop a framework for profitability. If you come at trading from a little bit of an analytical side, you can sometimes get too much in the weeds. But if you don't log your trades or take notes of your various average winners and average losers and things like that, then you don't have the data to be able to make tweaks to. So kind of finding the happy medium of, okay, I'm a trader and I'm here looking for opportunities, and I may not place every trade based 100% on these 5 things that line up exactly. But if I see an opportunity, I'm going to look at, okay, how can I contain my risk as best as possible to be able to capitalize on a potential move. And so that kind of 3 to 1 risk to reward ratio is a good starting place. So the tools that I use on my charts is Hakanashi candlestick, which is kind of a variation of the traditional candlestick. And it just helps me kind of get a better visual of the trend. Like I said, that Fibonacci tool, the 50% is not actually a fib number, but it's just an easy way to draw up retracement. And then I'll use the tick chart instead of like a 2-minute or a 5-minute chart. I'm using a 512 tick chart. And again, that's just a slight variation. When the market's moving fast, a tick chart, a 512 tick chart on, say, the E-mini S&P, it might take 10 or 20 seconds for a candle to form, or even less if we're really moving. If it's after hours, which is time that I don't trade, it might take minutes, or 10, 20, 30 minutes sometimes for a candle to form. And so you get a lot of information that you can extract from just the chart itself without having any indicators or moving averages or volume or any of that stuff on the chart. By keeping things really simple, you can extract a lot of the real core meat that's going to give you the information to place good trades. And it's something just like becoming a doctor or a lawyer or a professional athlete. You work at developing good habits and reading the game or we can't really read other players like you would in the trading pits, but we can use the chart as a way to read into maybe some of the emotional things that are happening as a group of traders as a whole. Obviously, when we look at the chart, we're not just seeing one trader, we're seeing the collective result of a group of traders. And so there's a lot that you can pull out from just the chart itself, but it takes time and observation and a lot of patience to be able to work through and kind of pull out those patterns, looking for patterns and coming up with a hypothesis and then testing that hypothesis or that theory. And so once you start developing those good habits and start seeing, okay, I'm having some success with entering at these levels, then you can start to trust your intuition a little bit more. But a lot of times, folks who come into trading have the mindset that's sometimes completely backwards, and it's shifting that mindset from the opposite of what they should be doing, and they're thinking like everybody else, so they're getting stopped out when the more veteran trader is taking profit, and the amateur trader is trying to get in a position. So you have to kind of flip all that on your head. And so taking notes of your mental state can be really helpful. Just writing down your thoughts during the day. That way you're just acknowledging, okay, I'm in a trade, and it's been a couple minutes. I still haven't gotten a first target hit. I'm kind of nervous. I'm thinking about moving to break even. Well, if you spend the time, writing that stuff down, it can kind of be a distraction from your trading, which in that case can usually be a good thing, but it also causes you to, really think about, okay, well, if I'm feeling nervous and I want to move to break even, there's probably a lot of other traders out there that are doing the same thing, and usually, sticking to your guns and just hanging on a little bit longer, giving your trade, especially in the ES or day trading any of the E-minis, giving your trade room to get away from your entry is the most important part. Once you're 3-4 points into the trade, then managing your stop is the easy part. And I'm sure you've had trades where you've gotten out and then you look back and the market runs 10 points and you say, well, if I would have just stuck to my guns and not closed out of the trade early because I got scared, it would have been a great trade. So let's talk a little bit about the way that I exit my trades and how I set some of those profit targets. So we talked about the 3-to-1 reward to risk. You can use negative 23% target is kind of a way to use the Fibonacci tool to get a little bit of move beyond highs. That's sort of in a little kind of a sweet spot, if you will. And it's helpful to look at your trades when you're analyzing them in groups, 20, 30 trades at a time, so you can kind of minimize the outliers and get a better perspective. And then using calculations like your R multiple, how does your profit relate to your risk, your expectancy, those kind of things can be really helpful. And they're good tools to be able to kind of gauge, how things are going. And so when you combine looking at your reward to risk with a group of trades, you can make better assumptions and little tweaks than if you're just looking at, one trade here and one trade over there. So the way that I like to trail my stop, I've got two main approaches. I guess the first way would be to have a small profit target. So if we're talking, 3 contracts on the E-mini S&P, having a small target of 2 points is a good way to be able to, capture and reduce risk, capture profit and reduce risk on the trade if the trade's not going to get some follow through. And a lot of times, there's trades that get a little kick and then they change direction. So we want to be able to, not take the whole position off at a point. It doesn't do you any good to put down 10 contracts and then take 8 of them off for a point. But if you've got 3, taking 1 off at 2 points with a 1.5 stop, now that's reasonable. It cuts down on your loss because you've taken a profit and you've cut out one of the contracts. So if the trade does come back and go against you, now we're talking break even as opposed to not a big loser, but just a full stop out. So technique 1 for trailing my stop is to trail the swings. And I'm just trailing above or below the swing highs or the swing lows. So if I get in a long trade, you can do this intraday, you can do this on a daily chart. I'm just trailing my stop by physically moving it underneath the swing low. And then when the market makes a new high and then pulls back and makes another new high, well, then you have another swing low formed, kind of going back to the helpful exercise of printing out that 5-minute chart, marking the highs and lows. It's another good way to develop a good eye for spotting swing highs and swing lows. So I'm just basically moving my stop up underneath swing lows as long as I'm in a long until the market pulls back and breaks a swing low, which by definition is the likely point of a trend change. And so my stops are based on places where the market is about to or likely to change trend. So just by trailing swing lows, that's kind of my conservative approach. And it's a really good way to get in a trade and give it some wiggle room, but also be kind of on top of it in case the trend is going to change or start to break down. Now you get out as the trend is changing. And then technique number 2 that I use, and again, it could be an intraday chart, 5-minute chart, a daily chart, hourly chart, it doesn't matter, is to trail each candle. And so this is more aggressive if the market's moving really quickly. But again, I'm just trailing above or below the candle's high or the candle's low. So if I'm long, I'm just trailing underneath each candle's low. Every time the next candle makes a new high, I just take my stop and I hover my mouse over the price of the candle and I just move my stop a tick underneath that prior candle's low, and then the next candle forms, move it up underneath the next candle's low. And sometimes you get these, you get in a trade and it's sitting quiet and all of a sudden, boom, 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 you're 4 points in your favor. And rather than letting it come all the way back down and give up that profit, or letting it just, letting yourself just hit the flatten button or just close out the trade at some arbitrary spot, I would rather trail my stop very tightly. And by using each candle's low for a long trade, that's a good way to just be following along. I don't know when this little spike is going to end, but if you've got 3 contracts, you can let's say even if you got 2 contracts, the first one you could trail aggressively like this if the market starts moving really quickly. And then the second contract you could trail conservatively so that you get stopped out of the first contract and let's say it goes a little spike for 3 points. And then you've got another contract that has a stop that's lower and the market might get a little bit bigger pullback, but not all the way to your secondary stop. And that way you're not putting on a new trade, taking on a full stop out risk potential again. You're already in a trade, and just by managing your stop, it does so much for keeping a level head, staying focused, and it can be a really good way to just keep that good rhythm and flow going. So those are the 2 techniques that I use to manage my stops. And in terms of staying in winning trades, it's important to be patient at the start. Like I said, that's when the when the trade is just started, it tends to chop around a little bit more. But once it gets away from your entry, that's when we can switch to trailing our stop. And so I will wait for a break of a little swing high, if I, again, using this example in the long. So letting the market move up and down in those first couple points, give it some wiggle room. I don't micromanage my stop, but once we break above the anchor point high or the swing high, whatever you want to call it, that's when I'll start tightening my stop. And so that way I'm not, a point in the black and just moving my stop to break even and then get stopped out and then the trade goes my way and I'm frustrated because it was a big winner and I'm sitting on the sidelines not in it. So the last thing I want to touch on, I guess the second to the last thing, is 10 things that I've found really important to my own trading. So it's important to remember that the market can always go higher, it can always go lower. So even if it's early in the day and we're starting to, let's say we gap up, the market can still go higher or lower. As we just talked about, it's important not to tighten your stops too quickly. It's okay to give up that small winner because, when you trade, if you trade the same way every single time, then you can catch those bigger winners. And, don't worry about that 1 point winner. We want to get to that 3 or 4 point winner. It's really important to maximize the winning trades, put the emphasis there instead of the number of trades you're taking. So rather than trying to get 5 winners and micromanaging the position, I would rather just maximize my trades to have 2 bigger winners. It's really helpful to trade the same way every single time. Keep things as simple and keep a framework that you're going to repeat over and over again. Analyzing the numbers can give you a lot of details, that a lot of kind of light bulb moments by going through and give you some good ideas for tweaking your methodology, because it's really all about probabilities, as Eric was talking about prior to this presentation. I found that trading less leads to more profits, so I might make 2, 3, maybe 4 or 5 trades in a day, somewhere in that range, in like a morning, a couple hours. It's rare that I make, very rare that I would make like 10 trades. And over the years, I've traded less, but I'm in those trades longer because I have more contracts and I'm scaling out. I think it's important to remind yourself that you don't have to make a trade today, and that can be really freeing, because it reminds us that, I'm here to trade a good market, not to force things if the market's not giving me any opportunities. And then finally, keeping it simple is the best approach, and being as hands-off as possible, not micromanaging things, and putting all of these things into practice can really help accelerate your trading forward. But I always like to end with, there's no shortcuts or substitutes for time in front of the screen. And it's important to be patient, but really work smart. Put your energy into, focusing on a small time window, one market, one time frame. I'm going to trade, the first 2 hours of the day. And that's going to really help to keep you disciplined and keep you on track. So if you want to find out more about me, you can visit eminimind.com. Lots of good stuff over there for free. And if you're interested in more of like my trading setups, live trades and examples, and putting all this stuff into practice, you can check that out over at eminimind.com and just click on the trading rules tab. To get that, you can use the code SAVE20 to get the 25% off the ebook through the weekend. And if you have questions, you can always email me. I do a live trading room every Tuesday where I just kind of talk about the markets and just is a way to look over my shoulder and I answer questions. You can follow along as I trade and kind of try and narrate some of the things that I'm thinking about. So you can use that save 20 code to get 25% off that. And if you want to email me, you can do that at tim@eminimind.com. And I appreciate everyone tuning in today. I know there's a whole lot of stuff in here, but as you go through your trading journey, trying to focus in on just constantly asking yourself, okay, what's working and what's not working? Let me double down on what's working and let me, push off to the side what's not working. And that will really help you steer the ship and stay on course. And whether it's trading, whether you have a business, starting a new venture, startup, new career, all kinds of things that get thrown at us. And if we're constantly asking ourselves what's working, what's not working, then we can constantly be making little tweaks to stay the course. So I appreciate everyone tuning in today, and have a great rest of your day.